So let's dig a little deeper into the mortgage interest deduction because this gets a little complicated. Any taxpayer can deduct mortgage interest for up to 2 personal residences. So that's your primary residence. It could be a vacation home. It could be a home where a relative is living, either an adult child or maybe some parents. Up to 2 residences are allowed a mortgage interest deduction. There's also a cap on the amount of principal upon which that interest is deductible. So for loans that are entered into before December 15th of 2017, there's a $1 million cap on the amount of principal upon which that interest is deductible. For loans December 15th and later, that cap has decreased to $750,000. So what that means is if you have a loan under the old rules, the grandfathered rules, let's say of $1.5 million, you can only deduct 2/3 of the interest. So 1 million divided by 1.5 is 2/3. For loans after the fact, that same loan of 1.5 million, if the loan was incurred or closed December 15th or later, that's going to be only half of the interest is deductible. The balance is completely non-deductible. There's no carryover. There's no keeping track of it. Just not deductible. Home equity loans they do still have a place on the tax return deduction list. If a home equity loan in 2018 or later is used to acquire or approve a residence, then that interest is still deductible. But many people use home equity loans for other reasons: education, credit card consolidation, other personal expenses. If that is the case, if that's what the proceeds of the loan were used for, then the interest is not deductible. So for tax preparers, they're going to need to ask a few questions of their clients beginning in 2018 to figure out what the use of funds were to determine whether home equity loan interest is going to be deductible or not. And if you are a current advisor and you have clients who have home equity loan lines, you need to take a look at your client base and say, okay, who has used this for other purposes and who has used this for actual home improvements, and contact your clients and let them know about the difference. Because perhaps, depending on the economics, it makes sense to redo the primary mortgage if you still meet those limits and get that tax deduction. Finally, refinancing fees are deductible. There are different rules depending on whether this is acquisition debt or refinancing. If it is a true refinancing of a loan, the points typically is what they're called. The refinancing fees are amortized over the life of the loan. So if a client refinances a loan for 30 years, then the fees are written off over 30 years. If it's a 15-year loan, written off over 15 years. Now, if there are points paid at closing on the original purchase, those are completely deductible in the year of purchase. So there's a little bit of difference there depending on whether it's an original purchase or a refi. So next, let's talk about other types of interest. Investment interest is deductible, but there are some pretty significant restrictions on that. Investment interest it could be margin debt, it could be other debt used to acquire investments. That interest is deductible only to the extent of investment income, but that investment income is only income, or the qualified investment income is only income taxable at ordinary income tax rates. So that means qualified dividends and long-term capital gains do not qualify as investment income for this purpose. It's only interest, short-term capital gains that are allowed to offset investment income. Now, there is an election that you can make to say, okay, I want to treat my long-term capital gains as ordinary income so I can take advantage of this investment income deduction. Sometimes that makes sense, sometimes it doesn't. But to the extent that a taxpayer cannot deduct investment interest in a current year, it does carry over indefinitely. Generally speaking, credit card interest is not deductible. However, if it's used to finance business expenses, or if somehow it's used to finance investment expenses, perhaps it's real estate investment, so you're using the credit card to pay for improvements or repairs, then the interest attributable to those expenses, not all of your credit card interest, but the interest attributable to those expenses is deductible, either as a business expense or as an investment interest expense. And investment interest would be subject to the limitations we just discussed. Next, we'll talk about charitable contributions. A lot of different rules around charitable contributions. There's an overall limit on the amount of income that can be offset by total charitable contributions. There's restrictions on what you can take a deduction for. So you can generally take a deduction for property, for investments, for cash, but you cannot take a deduction for your time. And basically that's because how do you value a person's time? Even if we say we value it at whatever your pay rate would be at your profession, first of all, that seems to not be a very fair way of doing things, since there's an extreme range, of course, of pay rates from the lowest jobs to the most sophisticated jobs, or I guess we should say the highest paying jobs, and certainly geography as well. But even, say, within the CPA world, various CPAs charge different rates. And so if my billing rate for my clients is higher than, say, my competitor's billing rate, wouldn't I just be tempted to jack up my billing rate and give all my clients a discount, but take a higher tax deduction? So for that reason, deductions of your time are not allowed. Charitable mileage is allowed. And then when we get into property, the type of property being donated is important. So it depends on whether it's just goods like used clothing, used furniture, whether it's appreciated securities. There are different caps there. It depends on the type of charity. Is it a public charity? Is it a private charity? And sometimes it even depends on how the donated property is used. So for certain goods, cars being the best example, your deduction as a donor depends on whether the charity actually uses that car in its exempt purpose. Then you get one value tax deduction, which is higher than if the charity just takes that car and sells it on and uses the funds, the proceeds from that sale, to further its exempt purpose. And in the case where the charity is selling the car on, they actually have to provide a very detailed form to the donor, to the taxpayer, saying exactly how much cash they received for the car, and that is the limitation for the deduction for the taxpayer. So you sometimes hear charities, I think public radio is a great supporter or proponent of donating your used car. As I understand it, regardless of where you are in the country, they just contract with somebody who comes out, not affiliated with public radio, and takes the car away, and then they sell it on. So in that instance, you are getting whatever that car eventually fetches at auction. So it does make a big difference whether you're donating a 5-year-old car or a 15-year-old car, the condition, the make, the model, all those things. So that's a great program if someone wants to get rid of a car and isn't really looking to trade it in, but you do need to be aware not only of the restrictions on the value, but in order to take that deduction, there are some very specific odometer readings and all types of things that the charity needs to supply in order for the taxpayer to take that deduction on his or her tax return. So last, we'll talk about casualty losses. The ability to deduct casualty losses has been curtailed by the latest tax law. Now it's really only available for those in presidentially declared disaster areas. The rest of the rules are pretty much the same, but even before, when the rules were less restrictive, it didn't have to be a disaster area. I really didn't have a lot of clients who took advantage of casualty losses because this needs to be an uninsured loss, so an unreimbursed loss. The loss needs to be more than 10% of AGI, and then there's also a $100 per occurrence threshold. And certainly I would hope for taxpayers who are working with financial advisors, they have been counseled by you to get appropriate levels of casualty and property insurance. And 10% of AGI is a lot. Certainly that happens. It happens to all kinds of taxpayers, and definitely in those in now the presidentially declared disaster areas. So Houston floods last year, the fires in California that seem to occur every year. Those people who unfortunately are not adequately insured, they would be candidates for this casualty loss deduction. One or two other deductions that we'll squeeze in here quickly. There are no more miscellaneous itemized deductions subject to 2%. You'll see reference to that in your textbook. Those deductions have been suspended for the next several years. However, there are a couple of miscellaneous deductions not subject to 2% that are still allowed. Those include gambling losses to the extent of gambling winnings only. Now, this is an itemized deduction, but it is not subject to 2%, so it's still deductible. And also terminated annuity payments, and we talked about that a week or so ago. So during this lesson, you learned about certain personal expenses that are allowed as tax deductions, and we talked about how the taxpayer decides whether to take the standard deduction or itemized deductions.